Hello, welcome to another short video regarding tax advice for owner-managed businesses. Today, I'm talking not specifically about the business, but rather about your individual situation and planning. A lot of business owners take the opportunity to use the income they're earning from the business to build an income-earning asset portfolio. One of the most common being buy-to-let property. This could also be considered to be things like furnished holiday lets. It may even be things like art collections, shares, jewelry, a whole range of assets that have significant value and can be used either to get a capital gain or to provide income. Now, one thing that people often want to do with this is be able to not only pass it efficiently through generations, but ensure that other members of the family can benefit from it now. A typical one being buy-to-let property. It would be very useful if the children or their children who were trying to buy a house themselves could access some of the income from the buy-to-let property. There's a range of considerations to look at if you start to consider what I'm going to talk of next, but the route that we usually take at CCM in these circumstances is a family investment company, an FIC, a FIC. The past few years, this has become more common, and when we first started to do it, people did raise significant eyebrows to what on earth we were actually trying to do. A FIC, though, is a lot more useful, I believe, than a trust fund is nowadays, because trusts have become very tax inefficient and rather complicated. Whereas a family investment company, a FIC, can be quite easy to understand if you already own a business. Essentially, you create a limited company which has different classes of shares. The share classes, we call them A or B or C, can be distributed amongst different members of the family. The assets which you have and which produce income, which you would wish to share amongst the other members of the family, can be introduced into the company, either by way of shares or by a gift or by loan. There's different ramifications for each, and I wouldn't cover that in this video, but having put the assets within a limited company, they generate income, make a profit. That income is taxed at corporate rates, 19%, and using the different share classes can be paid to different people at different proportions, meaning that you can still control the underlying asset. You still have the ownership of that buy-to-let property because your share class is the dominating share class, and the rules of the company, as determined by the shareholders agreement, the articles and memorandum of association, give you the rights to be in charge as the older generation, but you can pay the dividend, you can pay the income received from the assets that you put in via dividends to somebody else. Very useful, again, as I say, specific example being a buy-to-let portfolio could be held within a family investment company. The parents who have created this still own it substantially. A smaller proportion of the ownership by way of shares can be given to the children at formation or via a gift. In so doing, it can have significant inheritance tax savings. That's a side issue, side consequence, and again, beyond the scope of this particular video. But the children can then receive dividend income, allowing them to fund universities, allowing them to fund their own mortgages. Particularly useful if you, as the older generation, are a higher rate taxpayer, but they are a lower rate taxpayer. You have significantly sidestepped a larger tax bill whilst getting the income that you don't need to where you want to do it. Although this may sound complicated, in terms of accountancy, finance and tax, it's actually very straightforward and can actually be done in a very simple way. The law of limited companies is modern. The law of trusts is very old, which means this is a lot more understandable for most people to get and can, once set up, be administered by almost any accountant. Now, setting up sometimes does require specialist skills, and it is something that I personally do. CCM have done a range of these for clients over a number of years with regards to estate planning and inheritance tax. It allows, though, a simplistic approach that can be readily understood and protecting of assets through a family. So if you are in a situation where you have a range of assets that are income producing or otherwise, that you don't immediately have need to get to, and which you are looking to either pass on or give away the income for, please do contact myself, Andy, or Jamie with regard to looking at a family investment company, a FIC. As ever, if you do wish to talk to me, the best way of getting to me is going on our website, looking at the team page, and booking an appointment from my online diary there. Thanks ever so much for listening. I'll talk to you again soon.